Hey everyone, in this video I'm just going to give a quick introduction on time and price and how it relates to intraday price action. Time is important in the first place because price movement does not exist without time. No matter what chart we're looking at, we are always considering some time element. Usually we are looking at charts where time scales linearly, meaning that each bar represents 5 minutes, 1 day, 1 week, whatever it may be. And we also know that price rarely moves in a straight line up or down. We can pretty much always anticipate some fluctuation to occur. And when we have a higher time frame bias for market structure, we can exploit these fluctuations in lower time frame price movement, knowing how these candles are formed on higher time frames. So what does that mean? Well, if you look at how candles are formed in the first place, you know that in a bullish candle, you're going to have an open right here, price trades down to a low, trades away from it to create a high, and then trades back inside of that range to create a close. More often than not, this is what you're going to see a candle look like with a body and two fairly significant wicks. And same goes for the downside. You're going to have an opening price right here. Price trades away from it to create a high, trades down to create the low, and then trades back within that range to create a close. So if you're looking at this as some higher time frame chart and you're looking for some lower time frame entry, then ideally, if you were bullish, you would want to be buying below this opening price. That would be the best possible entry for this scenario. And similarly, if you were bearish, you would want to be selling above the opening price because that would be your best possible trade. And if you simply lack a higher time frame bias, then you can simply pay attention to market structure and let that guide you. So I'm going to go through some examples that are purely based on the 2022 ICT mentorship model. And throughout these examples, I want you to note a few times of the day that we're watching. So we're going to be looking at the NASDAQ futures for all these examples, and we're going to be talking about these times in Eastern Standard Time. So throughout the week, you usually have some news events at 8:30 a.m. And then obviously 9:30 is when the market opens, so you expect some volatility there. And then pretty much every hour or half hour after the open, you just want to be aware of where price is trading. That way, if you have a bias, you can anticipate where it's going to create its open, high, low, and close. So I have marked here 11 o'clock, 12 o'clock to 1 o'clock, which is deemed lunch hour in the New York session, and 3 o'clock and 4 o'clock or market close right here. Now, I'm not saying these are the best times to watch. You could easily put on a 2 o'clock or a 1:30 or something like that, but these are the ones that I want to focus on today. So for this example, you can see at market open, price chops around a little bit here, creates this market structure break pretty energetically, leaving behind this fair value gap. Price does trade into it a little bit right here and trade away from it, but then once the clock turns to 11, we have new half hour and hourly candles and all that. And so price trades down to create the low, filling that fair value gap completely, and trades away from it to ultimately reach buy-side liquidity. Then at 12 o'clock, we open right here, trade away from it slightly to create that high, and then create a low coming all the way back to discount of this entire range, and then trade away from it to create the close. So if we were to take a look at the half-hour chart right here, you can see this is the same range. This is where the fair value gap was right here. And so 11 o'clock hits, price trades down to create that low, and that's what this wick is right here. Trades away from it to create the high right here. Trades back down all the way into discount, that's what this wick is, then trades away from it to close. So you can see how time becomes relevant here when we're anticipating new hourly and half-hour candles to form. Because once you get this market structure break and fair value gap, you could make a case to have a bullish thesis. And then once this new hour turns, you could see this as simply manipulation on a higher time frame before reaching the ultimate price objective. And same thing for after buy-side liquidity is taken. You know that a major level was hit, and now we're just chopping around in this area, not really creating a run on liquidity, but rather a sweep. And you know that the new hour forms right here, so we create this high, and we could potentially head lower. So another example right here, market opens at 9:30, trades up into buy-side liquidity, breaks market structure and leaves behind this fair value gap. Then at 11 o'clock, price opens, trades higher into the fair value gap, then proceeds lower into discount of the range and ultimately hits sell side right here. It creates the low around 11:45 and then trades away from it to create the close. So again, if we were to look at a 30-minute chart right here, we could see this is where the fair value gap was. And now at 11 o'clock, price opens, trades away from it to create the high, then proceeds lower into the discount range to create the low, and then trade back through to create the close. Then another example here, 9:30 open, price trades through buy-side liquidity, chops around for a bit, 12 o'clock starts, and suddenly we break market structure and leave behind this fair value gap, trade back up into it, and then proceed lower into the discount range. So again, on a 30-minute chart, you can see once 12 o'clock hits right here, this is where it opened, barely trades higher to create the high of this half-hour candle, trades lower to break a market structure and come back in to close. Then a new half-hour candle opens right here, trades slightly higher into the fair value gap and order block, then proceeds lower into the discount range before trading away from it to close right here. And ultimately, this one did trade into a fair value gap that was left behind from the opening session. That was also present on the 30-minute chart as well. So some key takeaways from this are that certain times can trigger certain buying and selling algorithms. In this case, we're looking at certain times a day, but it could easily be translated to times of the week, times of the month, etc. And that's extremely relevant when talking about market maker buy or sell models, which I made a video on a couple weeks ago. I'll link that in the top right. And we also know that candles rarely form without upper and lower wicks. Therefore, we can expect some manipulation that may cater to our bias. So this whole time where we're looking at market structure breaks and then price opens for a new half-hour or hourly candle, we can expect some manipulation to create that local high before continuing lower to complete our higher time frame bias. But anyway, I hope this was a sufficient demonstration. If you found this helpful, please let me know. And also feel free to let me know what topic you want to see covered next. But that's all I got, so thank you, and I'll see you in the next one.